Hello everyone. Today we discuss about the fundamental of accounting, part 2. So first of all, we discuss about the distinction between bookkeeping and accounting. Bookkeeping, uh, output of bookkeeping is an input for accounting. On the other hand, accounting output of accounting demerit informed judgments and decisions by the user of accounting information. Bookkeeping purpose of bookkeeping is to keep systematic record of transactions and events of financial character in order of its accuracy. And on the other hand, accounting purpose of is to find results of operating activity of business and to report financial strength of business also. Bookkeeping is a foundation of accounting, and accounting is considered as language of business. Objectives of bookkeeping is to summarize the cumulative effect of all economic transactions of business for a given period by maintaining permanent record of each business transaction with its evidence and financial effects uh, on accounting variables. An object of accounting is not only bookkeeping but also analyzing and interpreting reported financial information for informed decision also. Now, accounting cycle. When complete sequence of accounting procedure is done, which happens frequently and repeated in same direction during on accounting period, the same is called an accounting cycle. Now, recording of transactions. As soon as a transactions happens, it is at first recorded in subsidiary bank journal. The transactions are recorded in journal chronologically. Ledger. All journals are posted into ledger chronologically and in a classified manner. Trial balance. After taking all the ledger account closing balances, a trial balance is prepared of the end of the period for the uh, preparations of financial statements. Adjustment entries. All the adjustment entries are to be recorded properly and adjusted accordingly before preparing final statements or financial statements. Adjusted trial balance. And adjusted trial balance may also be prepared. Closing entries. All the normal account are to be closed by the transforming to trading account and profit and loss account. Financial statements. Financial statements can now be easily prepared, which will exhibit the true financial position and operating results also. Now, basic accounting terms. In order to understand the subject matter clearly, one must grasp the following common expressions, always used in human or business accounting. The aim here is to enable the student to understand with these often used concepts before we embark on accounting procedures and rules. You may note that these terms can be applied to any business actively with the same connections or connotations. First, transactions. It means an event or a business activity which involves exchange of money or money's worth between parties. The event can be measured in terms of money and changes the financial position of a person. Purchase of goods would involve receiving materials and making payment or creating and obligations to pay to the supplier at a future date. Transactions could be a cash transactions or credit transactions. When the parties uh, settle the transactions immediately by making payment in cash or by check, it is called a cash transactions. In credit transactions, the payment is settled at a future date as per agreement between the parties. Now, goods and services. These are tangible article or commodity in which a business deals. These articles or commodities are either bought, thus sold, or produced and sold. All time, what may be classified as goods to one business firm may not be goods to the other firm. For a machine manufacturing company, the machines are goods as they are frequently made and sold. But for the buying uh, for the buying firm, it is not goods, as the intention is to use to it as a long term resources and not sell it. Services are intangible in nature, which are rendered with or without the objective of earning profits. Profits. The excess of revenue income over expenses is called profit. It could be calculated for each transactions or for business as a whole. Loss. The excess of expense over income is called loss. It could be calculated for each transactions or for business as a whole. Asset. Asset is a resource owned by the business with the purpose of using it for generating future profits. Assets can be tangible and intangible. Tangible assets are the capital assets which have some physical existence. They can therefore uh, therefore be seen, touched and felt. Plant and machinery, furniture and fittings, land and buildings, books, computers, vehicles, etc. The capital assets which have no physical existence and whole value or whose value is limited by the rights and anticipated benefits that possessions confers upon the owner are known as intangible assets. They cannot be seen or felt, although they help to generate revenue in future. Goodwill, patents, trademarks, copyrights, brand equity, designs, intellectual property, etc. Assets can also be classified into current assets and non-current assets. Now, current assets and assets shall be classified as current when it satisfies any of the followings that I described right now, it is expected to be realized in or is intended for sale or consumptions in the company's normal operating cycle. It is held primarily for the purpose of being traded. It is due to be realized within 12 months after the reporting date, or it is cash or cash equivalent unless it is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting date. Now, non current assets. All other assets shall be classified as non current assets and machinery held for long term assets. Liability. It is an obligation of financial nature to be settled of a future date if represents amount of money that the business owes to the other parties. When goods are bought on credit, the firm will create an obligation to pay to the supplier the price of goods on an agreed future date. And on when a loan is taken from bank, and obligations to pay interest and principal amount is credited depending upon the period of holding. These obligations could be future classified into long term non current liabilities and short term or current liabilities. Current liabilities. A liability shall be classified as current when it satisfies any of the followings that I described right now. It is expected to be settled in the company's normal operating cycle. It is held primarily for the purpose of being traded. It is due to be settled within 12 months after the reporting date, or the company does not have an unconditional right to deter settlement of the liability for at least 12 months after the reporting date, that is term of liability that could of a option of the counterparty results in its settlement by the issue of equity instrument do not affect its classifications. Non-current liabilities, all other liabilities shall be classified as non-current liabilities. Loan taken for 5 years, debentures used, etc. And internal liability. This represents proprietor's equity, that is all those amount which are entitled to the proprietor, capital reserve and undistributed profits, etc. Working capital. What is working capital? In order to maintain flows of revenue from operations, every firm needs certain amount of current assets. For example, cash is required either to pay for expenses or to meet obligation for service received or goods purchased, etc. by a firm. On identifiable reason, inventories are required to provide the link between production and sale. Similarly, accounts receivable generate when goods are sold on credit. Cash, bank, debtors, and bills, receivables, closing stock, and prepayments, etc. So represents current assets of firm. The whole of these current assets form the working capital of a firm, which is termed as gross working capital. So gross working capital equal to total current assets equal to long term internal liabilities plus long term debts plus the current liabilities and minus the amount blocked in the fixed assets also. So there is Another concept of working capital. Working capital is the excess of current assets over current liabilities. That is the amount of current assets that remain in a firm and all its current liabilities are paid. This concept of working capital is known as net working capital, which is a more realistic concept. So, working capital, that is net, equal to working current assets minus current liabilities. Now, contingent liabilities. It represents a potential obligations that could be created depending on the outcome of an event. If supplier of the business firm or files a legal suit, it will not be treated as a liability because no obligation is created immediately. If the verdict of the case is given in favor of the supplier, then only the obligations is created. Till that, it is treated as a contingent liabilities. Please note that contingent liability is not recorded in books of account but disclosed by way of a note to the financial statements. Now, capital. It is amount invested in the business by its owner. As you all know, it may be in the form of cash, goods, or any other assets which the proprietors or partners of business invest in the business actively for business point of view. Capital of owners is a liability which is to be settled only in the event of closure or transfer of the business. Hence, it is not classified as normal liability. For corporate bodies, capital is normally represented as share capital. Now, drawings. It represents an amount of cash, goods, or any other assets which the owner withdraws from business for his or her personal use. If the file insurance premium or proprietor or a partner of a business is paid from the business cash, it is called withdrawing or drawing. Now, drawings will result in reduction in the owner. Capital, the concept of drawing is not applicable to the corporate bodies like limited companies. Always remember this. Now, net worth. It represents excess of total assets over total liabilities of the business, and technically these amounts is available to be distributed to owners in the event of closure of the business after payment of all liabilities. That is why it is also termed as owner's equity. A profit making business will result in increase in the owner's equity, whereas losses will reduce it. Non-current investment. Non-current investments are investments which are held beyond the current period as the sale or disposals. Fixed deposit for 5 years. Current investments. Current investments are investments that are by their nature readily and realizable and are intended to be held for not more than 1 year from the date on which such investment is made. Now, debtors, the sum total or aggregate of the amounts which the customer owe to be business for purchasing goods on credit or services rendered or in respect of other contractual obligations is known as sundry debtors or trade debtors or trade payable or book debts or debtors. In any other words, debtors are those persons from whom a business has to recover money, an account of goods sold or service rendered on credit. These debtors may again be classified. Now, creditors. A creditor is a person to whom the business owes money or money's worth, money payable to supplier of goods or provider of service. Creditor are generally classified as current liabilities. Capital expenditure. This represents expenditure incurred for the purpose of acquiring a fixed asset which is intended to be used over long term for earning profits therefrom amount paid to buy a computer for office use is a capital expenditure. At times expenditure may be incurred for enhancing the production capacity of the machine. This also will be a capital expenditure. Capital expenditure forms part of the balance sheets. Now, revenue expenditure. These represents expenditure incurred to earn revenue of the current period. The benefits of revenue expenses get extinguishes in the year of the incurrence and repairs, insurance, salary and wages to employee, travel, etc. The revenue expenditure results in reductions in profit or surplus. It forms part of the income statements. Now, balance sheet. It is the statement of financial position of the business entity on a particular date. It lists all assets, liabilities, and capital. It is important to note that this statement exhibits the state of affairs of the business as on a particular date only. It describes what the business owes and what prepared after incorporating the resulting profit and losses of income statements. Now, profit and loss account or income statements. This account shows the revenue earned by the business and the expenses incurred by the business to earn that revenue. This is prepared usually for a particular accounting period, which could be a month, quarter, a half year, or a year. The net results of the profit and loss account will show profit earned or loss suffered by the business entity. Trade discount. It is the discount usually allowed by the wholesalers to the retailers computed on the list price or invoice price. Now, cash discount. This is allowed to encourage prompt payment by the debtors. This has to be recorded in the books of accounts. This is calculated after deducting the trade discount. So, that's the end of the video, my friends. If you like my blogs, please subscribe my channel. Thanks a lot for watching my videos.